Awesome. Okay, so that was the agenda. So let's start with a little bit of an economic outlook update. Virginia agriculture. So agriculture is Virginia's largest private industry, and by far, what we mean by private is that it's family owned or owned by individuals, which is something to be proud of and something that consumers are increasingly interested in. So something to also leverage. About 90% of the farms in Virginia are owned by families or individuals. The industry has an economic impact of around $82 billion annually and provides jobs to more than 380,000 employees here in the Commonwealth. And this is according to data from the Farm Bureau. Key sectors in Virginia, as it will not be surprising to many of you, include poultry, which is inclusive of both broilers and turkey, but also a very exciting nascent egg sector in Virginia, which is gaining some traction. Then, of course, we have cattle. You're not too far from the Shenandoah Valley over there, where cattle is very important, especially dairy. And then we also have row crops, including corn, soybeans, but also some small grains, wheat, barley, and others. Fruit and orchards, and perhaps the more relevant to many of us here today is viticulture. Okay, so the United States Department of Agriculture, through their Economic Research Service arm, puts out these reports on a regular basis that assess the industries, the state of different industries, agricultural industries in the United States. I'm going to show some highlights from the latest, and it was in September, the latest report related to grape. The U.S. grape crop was forecasted again as of September of this year to be about 5.6 million tons, which is about 3% higher than in 2024, but 35% lower than the 2013 peak, which was around that time about 8.6 million tons. Domestic grape production in 2024, so last year, was the lowest since 1987, as grape production in top grape producing state, unsurprisingly, California, has trended downward over the last decade after peaking again in 2013 at 7.74 million tons. If you just compare those numbers, 7.74, 2013, you will notice that California accounts for a large majority of US production when it comes to grapes. And this is inclusive of both table grapes and grapes for processing. And then a little bit, it's about 18% of the fresh market, just the state of California. In 2025, grape production is expected, so the forecast is expected to increase in California, New York, and Oregon, and decrease in Washington on a year-over-year basis. Per capita availability, which is a sign of demand, right? So the number of pounds per person on average in the United States, for fresh grapes, was about 9.56 pounds per person in the last marketing year, an increase of 15% year over year, and the highest on record. Import volumes reached record highs, exceeding about 2 billion pounds and surpassing domestic production for the second year in a row. From August to November, California is the primary table grape supplier for domestic consumption. And we'll see a nice chart here showing us just such dynamic, right? The fresh grape sector is a game of windows, some people call it. There's a time window where the US industry for fresh grapes is profitable, and you're seeing it here. You see when California is most prominent from July to November, and then because of the weather conditions in the country, in the main producing states of the United States, that transitions away from US production as we go into the January timeframe, transition into Chile and Peru. But also Mexico and a little bit of other countries. So again, this is data by the USDA ERS Economic Research Service. In 2025, wine type, so not the table grapes, but for wine, production in California was forecasted to be about 3 million tons, 4% higher than 2024, but 16% lower than the previous 3-year average. And we continue to talk about California because that, with them being the largest producer, it has very important implication for prices. After producing a record wine grape crop in 2018 of about 4.3 million tons, wine type grapes acreage in California has declined by 40,000 acres from its peak of 590,000 bearing acres in 2018-2019. And you might have read some of the reports coming out about land values for vineyards in California not doing so well, right? There was this excitement over acquiring land for grape production in California for a while, and then all of a sudden it seems like it's a little bit losing that kind of traction, and some of that's reflected here in the second bullet. Washington, again, another very prominent state in the Northwest when it comes to grape production. The volume in 2025 is expected to be 120,000 tons. It's about 21% lower in 2024, and also 38% below the prior 3 years average of from 2021 to 2023. Oregon, grape crop, most of it goes to process, although the USDA does not separate what goes to process and to fresh, but we know from historical perspective that most of Oregon's stuff goes to processing, so we can basically call it that. The season is expected to be higher from 84, almost 85,000 tons to about 110,000 tons in 2025. So if you combine all of these things and you net the effect out, you'll see that there's an expected increase in California and Oregon. Wine grape production will more than offset the decline in Washington State for the year 2025. And again, this is as of the latest September forecast. Okay, so wine type grape production in the United States declined year over year, in California, Washington, and Oregon. And some of the reasons for this is that U.S. demand for wine has fallen over the last decade. Again, this will come as no surprise to many of us in this session, but wine per capita availability fell in 2024 to about 2.21 gallons per person. So we often think about that per capita availability or per capita disappearance as a metric of demand, and a decrease of 11% year over year and 30% below the peak of 3.13 gallons per person in 2013. And lastly, wine imports over here in 2024 were 18% lower than the 2022 peak. So even imports are suffering, right? So or French wines or Italian wines or Spanish wines, Greek wines for Argentina, and for those who are into those. All right, so let's look here at the graph that I'm showing is wine grapes crushed in California by whether they are white grapes or red wine grapes. And you see the higher share in recent years of red wine type grapes compared to white in the state of California. Again, California is such a big player in the market that it's important to keep track on their trends. The top wine grape crush in 2024 was Chardonnay with about 527,000 tons, followed by Cabernet Sauvignon with about 455,000 tons. These top two varieties accounted for 1/3 of all wine type grapes crushed in 2024. So 1/3, right, 33% material, but not the majority necessarily. But it's still very important to keep an eye out for. And let's just do a quick insights on processed grapes. So these include canned, dried, and juice products. In 2024, 2025, U.S. per capita availability of processed grapes, excluding wine, on a fresh weight basis was about 7.14 pounds, which is a decrease of 13% year over year. About 60% of that volume goes to dried, and again, this is U.S. level. All right, let's look at exports really quick. The trade is in a lot of people's minds these days. So we can see from this graph some of our most important trading partners when it comes to wine in the United States. A wine and related products, I should say, the most of this will be wine. So Canada, $460 million in 2024. The European Union, $168 million. And you might be surprised to hear that there's a demand for US wine in the EU, especially when they have some of the most famous wines in the world. The United Kingdom, which is now separate from the EU when it comes to their statistics, about $164 million. China, which has grown exponentially as a market for US wine, was at around $96 million in 2024. Japan, $80 million. And another surprising one, the Dominican Republic. I guess many of us might spend a lot of time in the Dominican Republic, and we may want to have some of our US wine when we are vacationing there during the bitter winters here in the United States. But anyways, that's a little bit of exports. And that was mostly focused on grapes, but a little bit of wineries too. But now let's look at the demand side a little bit more closely. And I'm grabbing some data here from IB's World. And if you haven't come across that resource, it's a very powerful tool for demand and industry updates and industry forecasts for different sectors of the US economy. At a glance, the wine sector in the United States had about $33.4 billion in revenue, a profit of $7.5 billion, which makes for a profit margin of 22.4%, so very healthy. Again, on average, and we know that average hide a lot, so there's a wide distribution of effects here. But yeah, about 57,000 employees. Again, these are just wineries. About $4.5 billion in wages. Products and services, so the different type of wines that are transacted in the United States, in addition to their market share, so how relevant they are in the market. You have the likely suspects there, Chardonnay, Cabernet Sauvignon, but also Zinfandel, Riesling, and other blends accounting for a healthy share. Pinot Grigio, Merlot, and Pinot Noir also listed towards the top here. Again, coming from IB's World, and this is as of the latest update. And we know that one thing that we know for sure is that consumers change their mind a lot. And that's going to be a recurrent theme of how we listen as producers, how we listen as processors, how we listen as stakeholders to these producers and processors, to the consumer needs, and respond to them proactively so that we can stay competitive in the market. And that is at the heart of value added and product differentiation, in fact. Let's look at the employees again for wineries. So you see a growing trend from 2012, when we had a little bit around 40,000 employees, to today, when we're sitting here almost towards the end of 2025 already, closer to 56,000. And then the other really nice thing about IB's World is that it offers projections about 5 years out, and we see that number to continue to increase to about over 60,000 employees. Profit margins have historically been healthy and growing, right? So we look back to the year of 2012, 2013, we were already moving towards that 20% profit margin. You know, ebbs and flows. Of course, we had the COVID-19 pandemic over here, and then some rebound after that. And we're sitting at about 22.4% as of the latest update here. Profit per business, so profit per winery in the country, about $1 million. But again, there's such a wide distribution of sizes and profitability levels that these are just averages. They're informative as they go, but they don't reflect the reality for each operation necessarily. This is very interesting, as I've been studying these markets a little bit this year. This report by the California Wine Institute shows total table wine consumed in millions of gallons in the United States. So take a little bit of time taking a look at that trend from about 1986 to about 1994. And what you see there is something of a demand correction. So the market adjusted in a very drastic way around that time. And then we continue to see that wine consumed. And again, this is not per capita, but total million of gallons of table wine in the United States, continued to increase since about 1994. Notice how not even the recession of 2008 had a strong, I mean, something of it, but not a strong impact on it. Quickly recover from it and continue the long-term trend. But now you're seeing a little bit of that correction again. What does that tell me as a business owner? What does that tell me as an economist? Is that for business owners and processors to stay competitive, you have to be very strategic and you have to be very innovative. In a period like this, like let's say from 1998 to 2014, business as usual, consumption is just growing, things are doing good, right? But we're seeing something of these corrections over here. So we have to be more strategic in the way we position our product and how we resonate with our customers to stay competitive in that market. Demographic shifts, I will just say a few highlights about that. Wineries have evolved into a highly competitive landscape where predicting consumer preferences is increasingly challenging. Younger generations display a notable shift in drinking habits, seeking variety and diversity in their choices. This shift has blurred the lines between market for wineries, breweries, and distilleries. In other words, there's just more demand for that same customer base, and that customer base changes their mind more often than perhaps older generations may have had, as older generations are generally considered to have had more consistent preferences. So it's easier to service those preferences because they are more or less stable, and we no longer live in that environment. So you can lament it, but you can also try to be proactive and try to leverage it for your own benefit. I want to leave you with a few closing thoughts. I should have mentioned at the beginning, we're going to make all of these materials available to anybody who signed up. So don't feel like you have to rush to learn everything in the slides. But what does this mean for all of us, right? What does this mean for us that work with the sector here in Virginia and beyond? What does it mean for us that might be producing or processing or extension agents, so on and so forth? This means that distinctive product and brand positioning is ever more increasing and ever more a strategic decision. It's not just a blah, 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 something that we say because we want to have something nice in our website. It's a very intentional business choice that you're making, and it can have strong implications for your bottom line. Premium and niche wines, small production, unique varietals, terroir driven, hold more resilience and value. And again, we're very fortunate to have Paul talking about his own operation here in Virginia and how they've gone about this. A strategy for all of us is to emphasize rare varietals, unique terroir, storytelling, limited production runs. So what is it special about what we're doing, and try to sell that story. Value-added and agritourism experiences. We are very fortunate where we are in Virginia to live very close to major population hubs, right? As a matter of fact, about 40% of the US population lives along the shore of the East Coast or East Coast states. So we have people close to us. I was at the British Embassy last January. I was talking to some folks there, and they were saying how a majority of farms nearby the big cities in England and the United Kingdom more broadly are offering now agritourism services, overnight stays, how people from the cities come spend the weekend at these farms, and of course they pay for these kind of things, right? So that's a very different additional line of revenue that these people are exploiting elsewhere. And again, especially the Winchester area, some of the Northern Virginia part where it's heavily populated, and we have these beautiful landscapes, this natural beauty, and the wine, and a very venerable history of wine production dating back to Thomas Jefferson and before that. It's something to exploit and leverage. These activities have the potential to build direct-to-consumer revenue, deepen customer loyalty, and enhance brand differentiation. What's the strategy here? Create immersive experience, vineyard walks, behind the scenes, seasonal festivals. Find a way to connect with your community and your customer base in a way that is innovative. This is something of a timeless thing, right? Operational efficiency. So if you're producing a commodity, the only lever that you have to improve profitability is to lower your cost, because you're a price taker. You can't do anything with the price. So the only lever that you have to pull is to be more efficient in the way you're producing. So this is just something that we always have to keep in mind. And this is true also if you're operating in differentiated, value-added type of environments. The more you lower your cost, higher your profit margins will be. assuming everything else remains constant. Given the macro pressure that we've been talking about, cost control and efficiency, it's ever more important. What's the strategy here? No. Is there any tools that we haven't leveraged in the past? Like, is there some soil analysis tools? Is there some precision viticulture? Is there any way to streamline our process, focus on quality or quantity, inventory monitoring, and things like that to avoid overproduction could be strategic. This is the last one, I think. Innovative use of technology and data. I'd be remiss if I don't mention this. Emerging studies show technologies like sensors, artificial intelligence, precision management, and vineyards and agritourism can increase efficiency and enhance guest experiences. Are there any digital tools that are at your disposal to monitor the performance in your vineyard, your guest management, your systems? And how can you leverage some of this data for strategic decision making? I wanted to give you a screenshot, and I'm not going to read this, of a recent paper that was published that talks about the use of sensors and related analytical predictions and how they can be useful tools in providing data-informed input to viticulturalist decision process. And again, I'm going to attach a copy of this report into the materials package for you all. All right, so what are we going to do for the rest of the day? Right now that we kind of like have set it up, we're going to explore the potential of value-added and product differentiation opportunities in Virginia agriculture. As we do that, we're going to do it in 2 different stages. We're going to talk about a short-term financial decision tool, which is a partial budget. And then some things don't play out in the short term. They need to be considered in a multi-year basis. So for that, we're going to talk about income statements as a tool that can be useful. And we're going to understand how these tools can help assess the financial potential of a new idea. You heard this, great thought amongst friends where you had a conversation with them at a coffee shop about something they wanted to do in their farm. But how do you know that that thing is going to pay off? And part of that answer is financial planning. Put the numbers to your idea before you even execute. And we're very grateful to have the Virginia Farm Bureau, Horizon Farm Credit, and the Briedé family farms joining us as we explore these things together. Again, as a community of friends with common interest. All right. So the next item in the agenda is going to be we're going to hear from Nicole Clem with Horizon Farm Credit. So very fortunate to have you with us, Nicole. Thank you for taking the time. And I have the slides here, so let me pull them up really quick. But yeah, I'll let you do an introduction. But from my perspective, thank you very much for joining us, and I'm excited about your presentation.
Sure. Thank you guys for having me. Like Mario said, I'm Nicole Clem. I am an ag relationship manager with Horizon Farm Credit. I've been with Farm Credit for about 5 years. I do work with some vineyards and wineries in the area. I also have grown up in this area. Shenandoah County is home for me. I serve Page, Shenandoah, Warren, and Jefferson County, West Virginia. So a little strip here in the Northern Valley. And just going to talk to you today about some of the products that we have at Farm Credit, and then kind of open it up for discussion, what you guys would like to hear from me. So Mario, if you'll switch my slide. And Ryan couldn't join us today. He actually ended up having a closing. So he said, I'll let you take the lead. So Farm Credit was created by Congress. We've been around for over 100 years. As things ebb and flow in agriculture, commercial banks will sometimes think, oh, yeah, this is a great opportunity, and start doing some ag lending. And then when we go through a drought or prices skyrocket or bottom out, then it's like, oh, pump the brakes. Maybe we don't want to be in the agriculture sector. There's too much risk. So Congress created Farm Credit to help have a consistent source of credit for the farming community. More than a third of all of agricultural lending needs are met by a Farm Credit Association. We are nationwide, and we do not take deposits. We also don't compete with each other. So depending on where you are located, you would have a different Farm Credit Association. So from Page and Shenandoah County north all the way up into Pennsylvania is Horizon Farm Credit. But if you're in other parts of the state of Virginia, you could be serviced by Colonial Farm Credit or Farm Credit of the Virginias. You'll flip for me, Mario. So this just shows the regional banks. We have 4 larger associations that service us. Each farm credit has its own board of directors. We are a cooperative, so we're member owned, and specialize in any kind of ag loans, from real estate, equipment, home mortgages. We do a little bit of everything. We're part of the Ag First District, shown there in green. So like I said, we are kind of in a unique spot. If you look, Shenandoah and Page is at the bottom part of that map. We have the entire state of Pennsylvania, Delaware, parts of Maryland, Virginia, and West Virginia. So a very large territory covering over 100 counties. Like I mentioned, we are a cooperative, so you as a member of the cooperative need to buy stock as part of your loan origination. It's a 2% fee or a max of $1,000, and then that gives you the ability to have profit sharing. We call it patronage. It's returned each spring based on our profitability, but we do return our profit to our members. So it has historically, patronage is never guaranteed. We could have a bad year, but historically the average is about 1% of your effective interest rate that gets returned to you each year. So we do all sorts of different loans, from a small $3,000 cattle loan up to multi-million-dollar farm purchases, and a little bit of everything in between. We are flexible in our terms. So I know this is a viticulture discussion. So if you're planting grapes and you have that large input cost on the front, but knowing that you're not going to have production for the first 3 years, maybe we would set that up on an interest only payment as opposed to principal and interest, knowing that you're not going to have anything to harvest in those first couple years. Likewise, if it were a cattle loan, you wouldn't want a monthly payment if you're only selling calves once a year. So that's one of the beautiful things about farm credit. We work with our members to make sure that we are setting them up for success by giving them a payment structure that makes sense. It also mentions leases on there. Leases are a great tool, especially for tax planning purposes. We can do leases on things as large as buildings, as small as wine barrels, specialty equipment, grape harvesters, bottling equipment, things like that. Those are all great products to have a lease. So not just loans, we also offer business services. We have beefed up our business services department. They can offer accounting, consulting, tax prep, record keeping. There's an entire team dedicated to that because we recognize the need. The accounting services, at least in our area, it's hard to find someone with farming background or knowledge to do those tax returns for you. So we have expanded down into the valley with that. We also offer crop insurance. So that's another discussion we could have. We have dedicated folks that sell crop insurance, and we can cover vineyards. Moving, oh, no, you're fine. Moving on, for just some of our specialty programs, our board of directors is very committed to the next generation. So not only in scholarships, if you'll flip to the next one, Mario, we have the Farm Credit Foundation. They do scholarships for seniors and those in college pursuing careers in ag. You only have to live in the Horizon Farm Credit territory. Michelle, this may be of interest to you. So they do award $10,000 scholarships, and there are 20 of them available. So it's not like you're a 1 in a million shot. Those have been being awarded for several years, and would love to see some local folks be recipients. Scholarship is currently open. Deadline is January 2nd. The address to check it out is there. I didn't know if there would be other students participating, but if you reference the map of Horizon Farm Credit territories, anybody living within our footprint is eligible to apply.
This is a great resource. We'll be sure to distribute it. We'll use Michelle to let us know who lives where.
Yeah. So internships, we also offer internships that are paid project-based intern positions. They're located throughout our footprint. Last summer, we had an intern in the Winchester office. He worked with our credit team, but lots of different opportunities from marketing, credit, loan officer trainee. There's a lot of different opportunities within Farm Credit. The deadline for that is coming up. I believe it's on the next slide. I think next Friday is the deadline to apply for one of the Farm Credit internships for next year. So some beginning farmer programs, like I said, our board recognized, hey, if we aren't helping people get started, we're not going to have a clientele come down the road. So they created, it's called Grow Ahead. It's a multifaceted program to help the next generation get into farming. So like I said, multifaceted, there are the 4 components: outreach, education, some modified underwriting terms, and our loan products are a little bit different to help support, whether it's somebody starting a new operation, whether that means you're a retiree looking to get started in something new, or you're that 18 or 19-year-old that doesn't have credit, but wants to get started and needs a way. So the Farm Starter program was created for those young folks that have the character, that have the capacity, the collateral piece is just missing, and that credit piece is unknown. Say it's a customer's child, you know, the next generation coming on, but at 18 or 19, you don't have any credit. So they created Farm Starter for those folks to say, hey, we recognize you don't have credit, but we want to take this on. So that's one example. If you'll go to the next slide. The education piece, Farm Credit has a great ag biz program. It's actually just opened up Monday of this week. Deadline is December 15th. It's a 2-year online program for Ag Biz Masters, but it will help you create a business plan, walk through financial resources. There is a fee for that. It's $225, but if you complete the course, it'll be reimbursed to you. So it's just making sure that people actually follow through on the training. We've gotten a lot of really good feedback on the Ag Biz programs. Ag Biz Basics is a faster paced, shorter term. The Ag Biz Masters is a 2-year program. So another cool thing that our board created was a grant program to help folks get started. Excuse me. There are 2 different grant opportunities. The first one is called Jumpstart. So that's for folks that have a business plan and haven't started farming or have less than 2 years of experience. And there are $10,000 grants awarded to those folks. They do not have to be repaid. There's not a match. It is truly a grant to go and execute your business plan. So Jumpstart is going to be coming open in Q1, and right now they're actually reviewing the Farmers on the Rise applications, and they'll be awarded in November. So Farmers on the Rise is still in that beginning farmer phase, less than 10 years of experience, so 3 to 10 years farming experience, and again, $10,000 grants, and there are 10 of those typically awarded. There's an interview process and a really nice ceremony that goes with that, letting folks share their vision, and it's a really, really nice program that they've put together. So what questions do you have for me? I'm happy to do more of a discussion format. We talked about what exactly you guys would want to know. Some of the key points, I guess, in farm credit financing, we talked about flexible terms, long-term fixed rates. A lot of commercial banks would do like a 5-year ARM, where farm credit can do a fully fixed rate on your loan. So the advantage of that, we also have note modifications. So if you see a decrease in rates, then you can call, or we actually monitor them, and I'd call and say, hey, rates have dropped today. Would you like to refinance? And it's not a new title search. It's not a new appraisal. It's a one-time modification fee, and you get that benefit of that interest savings. So really looking out for our customers and keeping them top of mind.
Let me kick it off with a question, Nicole. So if you have somebody walking into your office and they say, I have a 20-acre vineyard in the Winchester area, and I would like to build a venue for events, and they want, $200,000 loan, what would you like that person to have as far as like thinking through that proposal before they come to you?
So a business plan, obviously, what is the benefit of building this venue? What is your cash flow going to be? Because Farm Credit is a cash flow lender. So a lot of banks are collateral lenders. I've got my grandparents' 500-acre farm, and that's my collateral. Give me a loan. No, it doesn't work that way. We want to make sure that we're setting you up for success, which sets us up for success. So having that business plan, having some cash on hand, because we all know nothing ever goes as planned. Making sure that you have reserves. We can't preach that enough. That's one of the things, especially working with beginning customers. A lot of times cash is limited, but making sure you're saving, building that nest egg so that you can withstand the good times and the bad.
Thank you very much. Yeah, as a professor, oftentimes our students, I feel like they think that business plans are just something that professors are obsessed with. So I wanted to hear it from you. There's a hand raised here, so Kelly, feel free to ask the question.
Thank you so much. And Nicole, good to see you again, I suppose. We met earlier this week.
Yes, twice in 1 week.
I know, right? It's great. So quick question for you. I really am enjoying learning about the programs that you have to offer. Are these available throughout Virginia or just within the footprint of your farm credit program?
So the ones that I specifically spoke about are only Horizon customers. And actually, it's not even customers, it's anyone living in that territory. So you don't have to be a farm credit customer to apply for our grants, scholarships, internships, any of that. It's anyone living in the territory. I do know that Farm Credit of the Virginias has a knowledge center and they have beginning farmer programs. I'm not certain if they have the same grant programs or not. You would have to check with them directly.
Thank you.
You're welcome.
All right. Are there any other thoughts or questions that we would like to bring to Nicole? If not, it seems like there was one from the AREC. Since we have folks online from across the state and this is being recorded to share, can you please mention the other farm credit associations available throughout the Commonwealth?
Yes. So your other Virginia farm credit associations would be Farm Credit of the Virginias and Colonial Farm Credit.
All right.
And you can check, there are territory maps. It is a little confusing. Farm Credit of the Virginias borders up to me. So there's lots of times that people are confused by that. And then Colonial is more southeast Virginia.
So you have to kick them out if they get too close to you, don't you?
Unfortunately, I have to hand them off to Jason Miller down in Farm Credit of the Virginia's territory.
All right. Well, Nicole, this is fantastic. Thank you so much for spending this half an hour with us. And so many great resources that you share. I'll be sure to pass some of those internship opportunities for our students. And then more broadly, the young beginning farmer programs, how important those are. We continue to talk about the succession challenges that we have in the farm economy in the United States as a whole, but it's certainly the case in Virginia. So it's good to see that you all are supporting that through those kind of programs. So thank you so much.
Thank you for the opportunity. I appreciate it.
Of course. All right. So the next item in the agenda is we're going to have a conversation with Whitney Perkins. And Whitney is Assistant Director of Agriculture, Development, and Innovation with the Virginia Farm Bureau. I'm going to let her do the talking, but she and her team do some fantastic job, fantastic opportunities for value-added product differentiation and specialty products and supporting that environment and that ecosystem here in Virginia. So without further ado, Whitney, thank you so much for joining us, and it's a pleasure to see you this afternoon. And feel free to share your screen.
Thank you for having me. I'm excited to share with you all today a little bit about the Virginia Affairs program and all that we do. I'm going to share my screen here in just 1 second. As soon as my PowerPoint, it was loaded, but it let me open it again. All right. Share. All right. Can you guys see that? Can you guys see my screen? Did it share?
I thought it was loading for a second, but I still don't see it.
It's still black. Huh? What is it? Hold on. Let me close out one more time. Gotta love it.
No worries. And if you send it to me, I can pull it off here too.
Yeah, hold on. Let's try that. I don't know why it's having some troubles. Sorry, guys.
It's not a problem. There's more time than life, Whitney.
Yeah. I don't know why. How my whole computer is having some problems. And Mario. All right, let me just attach this file. All right, it should be headed to you, Mario. I'm sorry.
Sounds good. It's no problem at all.
Well, while he pulls that up, I'll go ahead and I'll get started. I'm Whitney Perkins. I'm an assistant director with the Virginia Farm Bureau. I'm a multi-time graduate of Virginia Tech, so happy to be joining you all today. And as I share, just please stop me if you've got questions about some of the programs that I'm going to review and cover. But the Virginia Affairs Foundation is essentially the economic development arm of Virginia Farm Bureau. And so I'm a Virginia Farm Bureau employee who is assigned to work on this foundation's initiatives, along with several other employees. For those of you who have been around the agriculture industry for a while, you might be familiar with Wilmer Stoneman or Tony Banks or others. We all work on these programs. We work specifically in value-added business development. That means a lot of things to a lot of different people. For us, what we work with is we work mostly with producers directly, sometimes groups of producers, sometimes maybe extension agents or county development officers who are evaluating maybe bringing in a business or opening, let's say, a commercial kitchen or something in their region where producers in that region will benefit from having that resource available to them. So we work mostly in cooperative and business development through the lens of business planning, feasibility studies, and specialize in several state and federal grant programs. And I will, once we get our PowerPoint up, I'll flip we can flip over to them, but
Just came through. One second.
it just came through. Perfect. Yeah.
All
If
right.
you can grow it in the state of Virginia, we've pretty much worked on it. So whether it's maple syrup, oysters in the bay, trout, viticulture, certainly wineries. We've worked with a number of winery operations. Awesome. There we go. And you can kind of flip through to our next slide, our services. Yep, our audience. These are our clients. So these are, this is a small sampling of some of our clients that we have around the state. You will see craft beverage there. We work with a lot of wineries across the state. So some of the programs I'm going to talk about today are relative to this. If we can flip over. In addition to working directly with producers, we also provide several free educational resources, largely to help, and you'll see it's fitting that Beyond Bottles and Barrels and Barley to Beer are certainly two of our educational white paper guides. But if you go to our resources tab on our website, vafairs.com, there are several resource links there. We at least once a year try to publish a free educational economic study of some kind. For example, in 2020, 2021, 2022, a lot of those free guide papers were focused around small volume red meat processing, poultry processing, retail meat sales. Our team was getting calls every single day with somebody who wanted to open a meat processing facility. The bottles and barrels one is a little bit older. That was probably early 2010, 2015. So the numbers are certainly outdated. But what these guides are on our website to do is they are meant for people who are beginning to think about adding maybe this line of business or starting or to pursue this business opportunity. And these white paper guides review different legal considerations, potential business structures, maybe key players like financing options to be considered, or regulatory guides that you need to be aware of that exist. And so they're not meant to be specific for an operation or for a specific business. What they're meant to be is if you're thinking about, let's say, opening a winery, or you're thinking about opening a meat processing facility, or you're thinking about opening a commercial kitchen, these are guides that help walk you through what that could look like, maybe some scenarios that we've seen work, and certainly a lot of probably dry business material, but really good to know to help you stay within the bounds of the law and know what your tax implications may be, or your zoning implications from your county, all of these types of things that you might need to consider as you start to think about opening these types of businesses. So nice light bedtime reading for you. We can skip over the Farm Relief Fund. These are some of the state and federal grant programs that Virginia Affairs focuses on. I'm going to speak specifically today to the USDA Rural Development Value Added Producer Grant Program. Please note that all of these programs are changing. Many of them are in flux. Some of them have moved between different federal agencies. Some of them are currently tied up. I say tied up, haven't been quite released. Some of them are behind schedule. Some of them are on schedule. So what's really important to note here is that there might be federal grant programs that could assist you in moving into high value, value added agriculture opportunities. If you'd like to know more about what those opportunities might be, certainly give us a call. I'm going to review in a very broad brushstroke one program today, and almost every rule that I'll talk about as a general rule, there might be an exception to, depending on your unique situation. So these can be very cumbersome programs, but that is not to be, hopefully that doesn't deter you, but there are professionals and there are resources that exist to help guide you through accessing these programs. And we can flip to the next slide. I always put in a slide about what grants are and what they are not, and how we encourage producers, producer groups, and agribusinesses to approach grants. Grants are essential a financial assistance mechanism that provide money or other direct assistance to carry out a very specific project. We hear a lot of times folks will call us up and say, where's the free grant money, or where's this? Although grants are wonderful and they can be very powerful tools, they are tools. And even though they might seem free, they are not free, because they do not come without a lot of work, reports, conditions, your expectations to comply with those. Every grant program that I can think of off the top of my head that is a state or federal grant program requires match. So you have to be prepared to put up some of your own money to access additional money. And we encourage people all of the time to see grants as a way, as maybe a short-term opportunity for your operation to receive cash or capital or inputs to help achieve a specific project goal. Maybe that's start the operation, or maybe that's advance the operation to the next level. But do not see these as a constant cash cow. These are not going to float your operation long term. They come and they go and they change. There are lots of rules and regulations around them. So they are great tools to have in your toolbox, but you really need to focus on, I love farm credit and the business planning, the focus on business planning. The grant programs want to see that too. You got to have a solid business plan. You have to be able to show that your operation, your business idea can stand on its own 2 feet without these grant funds. These are meant to be short-term infusions to help you reach that next level. They are not long-term fixes. So make sure that your business makes sense and can cash flow and operate on its own regard without these programs. So that's my plug for how to approach grants. Common grant requirements. These are just a few, and I won't list them all, but particularly as you start moving into state and federal grant programs, the more money that's on the table, likely the more requirements that there are going to be for having to show proof of eligibility, documentation around articles of incorporation and bylaws, being registered in the correct federal systems. Always, always, always make sure that you read. And I know many of these requests for funding packages can be 15 or 20 pages, 3 columns, size, 6 font, but make sure you read all of that in its entirety, not just the name, not just the paragraph program synopsis, but make sure you truly read through what that program is meant to do, what it can and cannot fund, because it's a lot of work to do some of these programs. And the last thing you want to do is learn that your grant got kicked out on an ineligibility because you didn't submit the right form, or maybe the project that you submitted just wasn't quite within the bounds of what that program was going to be supporting. So we can jump forward a couple of general application tips. Just make sure you read, always read, and we'll keep going forward through narrative and budget. We can skip to the next one. So value-added producer grant program. I'm going to talk very specifically today for just a few minutes about one program that we have seen a lot of viticulture operations take advantage of. It's called the USDA Value-Added Producer Grant Program. It's currently through rural development and the LAMP program. It's nationally competitive out of the Farm Bill. This particular program is geared towards helping farmers, so agricultural producers, the folks that own and operate the farm, who are looking to add value to their commodity. Now that can be done in a lot of ways, and I'm going to explain what that is later in this program. But if you're using 50% of the commodity and you are producing that into a value-added product, so grapes into wine, if you use in your wine production, 50% of your grapes you produce, and you use that in your wine, you could be qualified for this program. And we'll skip to the next slide. What is value added? So within this program, and as I mentioned, value added means a lot of things to a lot of different people. In this program, the definition of value added, there are multiple methodologies that they consider. One is local foods. Another very common one we see is change in physical state. Change in physical state, crushing grapes into wine is an irreversible change of state. So that's why many wineries are very well qualified to go through this program. There are several other potential ways that you can add value in this program, but most commonly we see them as local foods and change in physical state. We can go to the next slide. What does this program actually do? There are two different types of grants in this program. One is a planning grant. A planning grant might be best fit for a business that maybe they've been growing grapes for a while now. They're thinking about opening a winery on their property, but they're not quite sure if that's the right avenue for them. They know that opening a winery is probably going to require a lot of upfront capital to build out that facility. There's a lot of investment in having to buy or pay maybe a wine consultant, bottles, barrels, stills. I mean, you name it, right? We can start going on and on and on about just the list of things that we might have to consider if we're going to start crushing our grapes and turning it into wine. A planning grant might be a really good opportunity for somebody who's thinking about doing that, because that grant helps pay for business plans, feasibility studies, marketing plans, legal evaluations, things like that. So basically those really big pieces of documentation that if you wanted to then go to a bank and say, hey, I'm going to build a winery, and they're going to need that business plan, those potentially a feasibility study. This planning grant will help pay for those types of documents. It is a max award of $75,000, but keep in mind, inside of this program, as with many programs, there's a match requirement. So dollar for dollar match requirement. So if you're requesting, let's say $25,000 in planning grant money, you're matching with another $25,000 in planning grant in those materials. So that might get you up $50,000 to complete the business plan, feasibility study, etc. Working capital is the side that does what I like to call the more fun stuff. This is an award max of $250,000. It can be spent for up to 3 years. It is also a dollar for dollar match. So a $250,000 grant is a $500,000 project. And I will tell you, in wineries, it is not hard to go through $250,000 in post-harvest expenses. This program will not pay for production. So it is not going to pay for planting in your vineyard. It is not going to pay for irrigation. It is not going to pay for fertilizer. It's not going to pay for labor to help prune those plants or care for those plants. It's not going to pay for those types of expenses. It's going to pay from the time that you pull that grape off the vine to the time that you hand a customer a bottle of wine or pour them a glass of wine to taste and enjoy. It's going to pay for the expenses that move that grape into a wine product. So whether that's crushing, direct processing, barrels, bottles, labels, maybe a winery consultant. It's going to help you produce the best quality wine. Maybe tasting room labor, the folks that are going to be running around in that tasting room, making sure folks buy bottles of wine and buy glasses of wine and pour that. Certainly lots of marketing. So maybe that looks like a website. Maybe that looks like Facebook ads, or maybe that looks like advertising in Wine and Country, or what have you. But those are the types of expenses that it's going to help you pay for. And the reason it does that, the primary purpose of this program is that as you start or expand, particularly in value-added business opportunities, there's a lot of upfront costs that are incurred before you hand anybody a finished product, whether that's a bottle of wine, whether that's a cut of retail beef, whether that's a jarred product, whether that's an oyster, whatever it may be. There's a whole bunch of steps getting that project, getting that commodity turned into something that goes directly into a consumer's hand. And so this particular grant program is meant to help offset a lot of those costs for a short period of time, 3 years or less, while you work on gaining a long-term customer base, so that when these grant funds go away, you now have a customer base that's going to continue to buy that product from you for a long period of time and continue to cash flow the operation. This program is expected to be released November 1. Of course, I'm going to preface everything I say today by we will see what the federal government is doing on November 1st. But the new program regulation says that this program is supposed to operate November 1 to February 15. So now is the time, if you were interested in pursuing a grant for this year, now is the time to contact a member of our staff and talk about what that might look like. We are writing for that program. Whether they release the program in November or not remains to be seen. I have a feeling that with the program regulation having a due date of February 15th, whether they release the program on November 1 or not, that these applications will be due on February 15th, because that's what the program regulation says. So we can just skip forward. I'll skip through the next few slides since they were there for dairy businesses. Our results, year over year, we continue to grow. We've helped hundreds of producers across the state of Virginia help expand their businesses into value-added opportunities. In the last 3 years, we've written more than 45 business plans, and this is actually these are some older numbers because we haven't completed this year's numbers yet. 15 feasibility studies, close to 80 grant applications, and altogether that has a more than $48 million economic impact to rural communities, which is great to see those federal dollars get pumped back to Virginia to help Virginia producers, help them start and expand these operations, hire folks here in Virginia, keep them employed here in Virginia. That's what it's all about. And then we can flip to the next slide. If you'd like to work with us, the next slide will have my contact information on it. Feel free to give us a call or reach out. It is never too early to start thinking about what grant programs might be able to assist you. It is very common that we may work with producers for 4 or 5 years before they're really ready to go for a very large federal grant award. It is very important, particularly when you are going to infuse, let's say, $250,000 of capital into your business, that timing of that capital matters. When are you going to be able to get the most use to grow that business at the right pace at the right time? And so that's part of what we help do is figure out where you're at. How do we time these grant funds maybe to really be a catalyst to your business growth? We do charge a small fee, 1.5% of your grant request, as well as 25% of the additional documentation. Again, another caveat, a lot of these grant programs, if you start requesting over a certain amount of money, you are going to have to provide third-party produced business plans and feasibility studies and other documents. Very important you read the fine print. That's part of why we're here. We cost share these programs thanks to the generous support of some grants that we receive, Virginia Farm Bureau, and our other partners. And so it's really important that we help producers be able to access these funds and get those funds back here on the ground in Virginia. So next slide. This is my contact information. If you want to talk directly about how these programs might support you, I'm happy to do so. Again, it's never too early to start talking about these programs, to start learning about what they can and can't do and how they can assist you. And with that, are there questions? And it's a lot of information at one time.
I have one question. What kind of success rate do you see, let's say, with the working capital grant for somebody that has a plausible business idea, fully fleshed out, there's a serious application?
That is a fantastic question. That is hard to answer. Virginia Fairs has typically had upwards of 90% success rate year over year in that program. Some years we've had 100% success rate. It's very important to note, I always like to put the caveat, this is a federally competitive program. They did change some of the scoring this past cycle. They're going to continue with that. And they have been, the last several years, the funding in the program has been cut. So we saw closer to about 50% last year get funded. But it's always a risk. But I will tell you, the sooner you start working on these applications, the better. They're very large, they're very intensive. So waiting until the last minute is not your friend. Be early, really have a very well fleshed out work plan and budget. And that's the way to be. Virginia, of course, we're still waiting on the final numbers from the last cycle. We know who got funded. The general public doesn't know who got funded. But we've been told that Virginia was in and has routinely been in the top 5 states in the country to receive awards, both on number of awards received and dollars received.
That's awesome. And I'm sure that's in a big part because of some of the great work that you and your team do, Whitney. So I can't thank you enough for your time and for your presentation. Yeah. And if you're okay with it, I'm going to post the materials online with the rest of the materials of the
Absolutely.
workshop. But is there any final questions before we let Whitney go? All right, awesome. Well, thanks again, Whitney. Pleasure to see you.
Bye-bye. Thank you.
All right, so the next item in the agenda is Paul Briedé, and he'll let us know how to pronounce his last name. It sounds French. And he's going to talk to us about his winery operation here in Virginia and some of the rare cultivars that are apparently unique to Virginia that they deal with and how they use that for product differentiation and value added. So Paul, it's a pleasure to see you and a pleasure to have you with us this afternoon. Thank you for taking the time, and super excited to hear your presentation. So thank you so much.
Yes, you're very welcome, and thank you all for letting me be here today. I also want to thank Whitney, Loretta, my wife, who's not here today. Worked with her on that grant program, and it worked out really well for us, and I recommend it for everybody. Anyway, Briedé Family Vineyards is the name, and we started growing grapes in 2013, and we planted a larger portion in 2014. That's all we had in mind at the time, is that we're going to grow grapes, or we're not going to make wine or do anything like that yet, because we really had no idea about what we were doing, and thanks to the help of Virginia Tech and the Extension Bureau and everybody else. We are really getting there, and so we're proud to be here. We started growing hybrid grapes because we wanted to grow organically and biodynamically, and of course these type of grapes they don't need much spraying, and the maintenance on them is much lower. Then 2017 came around, and we had our first harvest. In 2018 we converted the barn. That we had a horse barn, which we didn't have horses in it anymore. We converted that to our tasting room, just the downstairs. And basically what I'm trying to show you is we're growing little by little each time. It's planting grapes, now we make wine, then we have to sell the wine. And so we didn't start out with a $3 million business, but we started out very small. In 2018, we only had 2 wines at the time, so what we did was we started a champagne house, so we were selling French champagnes, and of course selling the 2 wines that we produced. The reason we're growing these grapes and the reason we're making the kind of wines that we do is when people have a unique experience, when they come to our place, it's not like everywhere else where, they can buy the same kind of wines. They come to our place, first they tell us they'd never heard of us. And then the second thing they tell us is we've never heard of these grapes before. And it's a lot of fun. I mean, we get a lot of pleasure out of it. Because people will, not only did they not know us, they didn't know the grapes, the wine that they're drinking, and are coming back with great compliments saying that they really enjoy the wine and they buy the wine and take it home with them. We're one of the first producers of Arendelle, which was produced by Bruce Reich at Cornell University. It's a red grape. We're very happy with it. It makes a beautiful wine. And we've actually learned how to make wine with it, and we're letting it age right now. And so we're doing some fabulous things with that. We won many awards with the grape as well. Besides Arendelle, we grow Cayuga White, La Croissant, Marquette, Chamberson, and Pinot Meunier. And Pinot Meunier is the only vinifera left on the at our vineyard, and we use that in the production of our sparkling wine. People can only experience some of these wines at our place. They don't have them at these other wineries in Virginia. We produce right around 650 cases of wine a year, which is still a little bit higher than than where we should be. We probably should be producing right now between 550 and 600 cases a year, because that's about what we're selling. And we've actually reduced our production a little bit because of that. We don't want to be like other vineyards. We don't want to be a wedding event center or anything like that. We're small, we're boutique. We want people to come over and have a nice quiet setting and enjoy the beautiful views that they have here, because and this is what people tell us all the time, that it is very beautiful there now, and with the winter coming, it may change a little bit. We chose these vines, these hybrid vines, to move Virginia forward in the hybrid wine business. That's part of our history a little bit of what we're doing. As far as the business model goes, like I said, we started in 2013, a large planting in 2014. We were growing grapes. 2017, Tom Kelly, I'm sure that's a name a lot of people have heard about, stopped by, and he was one of our consultants that we used. And I highly recommend using consultants, especially when you're starting out. And he asked me, he says, "What are you going to do with these grapes?" I go, "What? I don't know. Okay, we never thought about that. That was kind of funny." So he says, "You're going to have to make wine with it. I mean, these are beautiful grapes. I mean, you got to do something with it." Anyway, my wife went to the Virginia Governor's Cup a couple of months before that, and met up with Matthew Finot. And she said, "Why don't you give him a call?" So we called him at King Family Vineyards, and he says, "Absolutely," only with a different accent. And he was very happy that not only were we organic and biodynamic, but he was extremely happy to work with these grapes because he had never worked with them before, and he did a great job. Part of our business model, and I looked at all your other speakers, and we have worked with some of them as well. We did not go to any bank or any loan institution to do this. We paid cash for everything. I was very fortunate to have a really good job before I retired in 2020. And we had saved quite a bit of money in our 401k. So we used that money to expand the business. And then we were lucky enough to receive this grant that Whitney was talking about earlier. So we received a $250,000 grant. So far, we have well over $1 million into the business with that $250,000 grant that really softened the blow. And the grant is not meant to put buildings up, but with that freed up enough money for us that instead of every year adding to the company, to make the company grow, we could actually put an extension onto our tasting room with the money that we had saved up in our 401k, and that has really helped us out. And all the other things in the program that the grant offers has helped us out as well. So we're very lucky to be here. So last year was in fall and the winters when we extended the tasting room, and it is absolutely beautiful. The demand has grown. Our customer service has grown. Right now, we get a lot of walk-ins, and that is always good because we have signs on the road and the highways, and it really brings people in, not necessarily because they see the sign and said, oh, well, let's turn around and go back. But we're located between Martinsburg and Winchester, Virginia, and there's a lot of people that travel back and forth twice a day that see the sign, so we become very well known amongst, these people driving back and forth saying, hey, if we want to go do a winery or we want to do something like that, they'll know exactly where to go. And that's what we're seeing. We target people somewhere between 45 and 75 years old. That seems to be our best and most loyal customers. We're not a playground for kids. So, we allow children, but they need to stay seated with their parents, just like as if they were going on an airplane to travel somewhere, or if they're going to a nice restaurant in town. Important things are the wine club. Wine club is, keeps the lights on. And the other thing that we found out that is very important is wine festivals. And these two things between the club and the wine festival really improves your revenue. And I would say between the two of those, just from our perspective, our revenue increases by roughly, I would say, $160,000 to $170,000 a year right now, and that amount is growing, and that far outweighs our labor costs at this point. So it really is a good thing. People come to our winery, and this is one of the things they want, an experience. A lot of times people are looking for sort of an event, so it's nice to have something planned for them when they get there. Customer service, of course, is very, very important as well. And the wine quality actually comes in as number 3. And we don't treat them as that. We treat them pretty much all the same. If we make a wine and it doesn't pass our taste test, then we're not going to put our label on it. We offer tastings. We now offer food. I think at Vidax, they won't let you make food from raw materials, but what we do is we reheat stuff, and this is what we serve to the customer, and that changes from time to time. So it's not, the same thing every time they come in. We do events, like I said. We had a cook-off the other day with chili. It was last Saturday. We do vineyard tours. Loretta has a golf cart that seats besides her 3 other people that she'll take in for a vineyard tour, and that is very good. Her tours are amazing. People come back from that and really learn a lot. Virginia's for Lovers. We work with them. That's the Frederick County Tourist Bureau. We have a really good relationship with them. Like I said, the USDA value added tax is a very important thing if you want to make your business grow. The other thing that is very important, and I appreciate Virginia Tech, Dr. Nita, Doug Pfeiffer, same as well, and of course the local extension service here with Mark. We've had a lot of help, and I don't think we could have, we wouldn't be where we are now. So anyway, like I said, we didn't know much about grape growing, and in the years we've learned quite a bit, and we're making a very decent wine. We've won many awards, especially with the Sparkling Winchester, which we've been making since 2017. We got 2 bronze medals with that wine in the last 2 years. So and that's in the world. So that we're very proud of that. Other big thing is when you do something like this is when you have a business, of course you need to make your business work, and you plan it ahead, and trying to make it profitable, as soon as you can. And the other thing that you need to add with that is an exit strategy. And this is part of the reason why we did everything in cash. That if we would have to exit for whatever reason, the economy, or one of us couldn't do this, like Loretta or I couldn't do this anymore, it would be really hard. That we don't owe anybody any money on this business. So if we needed to close it down, say for instance, and sell the real estate part of the business, we would not go broke. We have a great exit strategy that way. that we would not be losing the money that we put into the business. And so I think that is very important as well, even though we're not planning on that yet. So, and that's really all I have to say. And if anybody has any questions, I would be happy to answer.
There were a couple that came through in the chat. One was about liability. I saw it pop up.
I was
Yes.
asking about what does the liability look like with the wine festivals?
Okay, the liability, the festivals, they have their own insurance as far as that goes, and as far as us, we have to provide a letter of insurance that we have at least $2 million in liability insurance.
So it can be pretty costly to hold the festivals. What does the profit after the fact look like compared to the cost of liability insurance?
Well, what happens is, yeah, just like in Winchester, you had the Bloom and Wine Fest, and that's put on by the Apple Blossom, people. Anyway, we pay to enter the festival, and then in this case, we bring our own tent, and then we set up our stuff, and then we give people tastings. People will go to the festival and buy tickets from them, not us. And then we provide the tastings, and if they want to buy glasses or bottles, then they can buy them from us as well. Now, generally speaking, when we go to these things, our costs, depending on where it is, that we have to pay hotel rooms and, we have to maybe drive to Norfolk, which is 4.5 hours of driving. Then there, of course, is more cost involved in that for us, but some of these wine festivals, sometimes we walk away, after 2 days, our revenue is over $17,000. So that's revenue we cannot make at basically at the tasting room, unless we have something really special going on. It's generally speaking, it's 3 times, maybe, yeah, it can be as much as 3 times as high as what we could do in the taster room. So that's why it's so important for us to do these things. Not only that, but people will see us, and now we have become a brand that when we go to these different festivals and we repeat the same ones over and over every year, they actually come looking for us, and that is, I think, very important as well.
Great, thank you so much.
Yeah, you're welcome. Anybody else?
How far do you go, Paul, for those festivals?
Well,
what kind of geographic range are you going to set up as a vendor?
This last weekend we went to Town Point in Norfolk. And like I said, that's about a 4.5 hour drive, and we have to show up the day before to set up. Now, the nice thing is Norfolk is a really good and fun wine festival. We get there, we have 2 huge tents set up. They have the tables and chairs there for us. We just bring the wine and bring a couple of pallets that we put the wine on, and then of course the stuff that we need to help sell this stuff, banners and that kind of stuff. Beautiful black table covers, and to show who we are. And so that's a great show, and it takes 3 days out of my life, but it's well worth it. And it's so funny because we sell out. We make a chocolate wine. We're a really serious winemaker, but we have one wine that's chocolate wine that we make, which we make just for these festivals because it really sells. 65% of the people somewhere in that neighborhood prefer sweet wines over dry wines. So we take those down there, and this is what we sell. And it's fun because I came home Sunday night after the wine festival, we were sold out. Monday morning, we already had orders to be shipped to Norfolk for these wines that we sold out.
That's awesome.
The longest drive probably is to Smith Mountain Lake, and that was 3 weeks ago. And that was an okay fest, but it was not like Norfolk or the other one we do is Mount Vernon, which is a beautiful wine fest as well. And that's twice a year.
It certainly sounds like some great Christmas gift, some of these chocolate flavor wines. Great, Paul, this is a fascinating story. Thank you for sharing it with us. I personally can't wait to make the drive up there and come visit you. So you'll be hearing from us at some point. But congratulations on the business you've built. And it sounds like you've been very thoughtful, you and Loretta, your wife, as you're going through the motions and even thinking about that exit strategy that not a lot of people is thinking about that. And it seems like you thought it through and you have a good one for you and your business and your family. So thank you for the time you spent with us this afternoon. It's been a pleasure hearing about Briedé Family Vineyards.
Yeah, well, thank you, Mario, and thanks for inviting me, and we hope to see you at the vineyard.
Of
And
course,
thank you, everybody else too.
All right. Awesome. So the last but not least important session we're going to have today is the one that is going to be probably the most hands-on. So for that, I'm going to turn it over to Michelle and Miro, who are going to talk to us about some practical financial tools for decision making. And as you're thinking like Paul, or as you're thinking like Whitney was talking about, or Nicole, about making a change in your operation, the very first step that you ought to think about is this going to play out financially speaking, right? You might have a great idea, you heard it at a coffee shop or at a wine festival, and you're like, well, maybe that works for me too. So this is a good way for you to get some experience. And also as you're collaborating with folks that might be trying to go to those kind of decisions as extension educators and whatnot. So without further ado, Michelle, the floor is yours.
Awesome. I'm really excited to be here with you guys. I think Miru is going to go ahead and share our screen so we can get started. So I figured to start with some introductions. So I am Michelle Mickelwaite. I am currently a graduate student here at Virginia Tech pursuing my master's in agricultural and applied economics. I graduated with my undergrad degree in agribusiness last year. And so I'm currently a agri-food finance fellow through the Virginia Tech Cole Center, where I've gotten to do a lot of really cool projects and a lot of really cool work with finance. So some of the experience I've had with specifically the wine industry was last semester, I partnered with a small up-and-coming vineyard in Grayson County, so Southwest Virginia. They had vines planted, but they didn't have any sort of business plan. So I led a team of students in developing that business plan and really focusing on what value added strategies they could use. Specifically, we did go with an event-based wine tasting sort of business plan for them. And so that was a lot of really great hands-on experience I got to have. So I'm really excited to, share this knowledge with you guys and teach you guys some skills to be able to implement these techniques in your own businesses or help any of your, colleagues or any of that sort of things. Yeah. And then Miru, if you want to introduce yourself. I think you're muted.
All right. Can everyone hear me fine? Okay, great. So my name is Miru Yim, and I'm in my final semester of an agricultural and applied economics grad program at Virginia Tech. And so my research and a lot of my interests are around how markets can impact supply chains and better supply chains, as well as nutritional outcomes. So the Agri-Food Finance Fellowship was pretty perfect in tying everything together for me, and really showing us, what decisions to make, how to make those decisions, and really when to make those decisions. So we're going to shed a little bit of what we've learned through the fellowship with you today, and we're really excited to share those insights.
So to kind of get us started, as we've discussed a lot during this presentation, we're going to be talking about a lot of value added. And so what does that mean to you? And kind of how Whitney Perkins was talking about during her program, value added means a lot of different things, and it can look very different from business to business and industry to industry. But so specifically with wine, so if you want to go to the next slide. The wine industry, especially in Virginia, is a very value added based industry. And so, kind of what exactly is value added? So, it's giving customers something extra beyond the basic commodity. So, in this case, grapes would be our basic commodity. When you walk into a grocery store, you're not looking to go get grapes and go make the wine yourself, you're looking for that bottle of wine. And so, what can that look like? And so, you take your grapes and you add value by making that into a bottle of wine. And then you can continue adding value to that bottle of wine by offering things like wine tastings or event spaces. That all is adding value to that basic commodity that the customer wants. Because if you really think about it, the entire idea behind business and making a profit is the reason why customers buy products is because it gives value to them. I'm not going to pay my money if I'm not getting some sort of value out of it. And so, kind of based off of that, we have the idea of differentiation, which is making a product or service unique to distinguish itself from the competitors. And so, what is it that's unique about your product that makes it so that consumers want to buy that? And so, you're creating a unique value proposition. So, what is that unique value that makes it so consumers buy your specific product instead of your competitor's product? And so, as we know, wine, especially in Virginia, is a very competitive industry. So I think you can go to the next slide. So it's a very competitive industry. We have, over 300 different wine producers and wine businesses in Virginia alone, not even to mention, the entire US and the entire world, all of these different companies. How do you make your wine bottle stand out on the shelf? And so, like I kind of mentioned, it is a very value added industry. And so, what does that kind of look like? And so, this graph that we're looking at, which is from the Wine Business Analytics, their 2025 report. And so, this is average tasting room conversion rates. And so, what this is looking at is um, what buys that bottle of wine. And so, for example, so when somebody visits um, your tasting room, what comes from that? And so if we look at east of the Rockies, so because we're talking about Virginia here, 78% of customers who visit a tasting room end up buying a bottle of wine. And that's really what we want out of doing these different things. And so being able to provide that added value of having something like a tasting room really encourages your consumers to buy a bottle of wine. And so if we look from this next source, 56% of revenue from the majority of U.S. wineries comes from direct-to-consumer sales. And so that is those wine tastings, those event spaces, where you're directly selling to your consumer rather than, like a grocery store or something like that. And so it's really important having that direct access to the customers. And so not only is like that value added, but that direct-to-consumer sales is also really important in this industry. And so we can kind of continue looking at that, like how do we get our product to our consumer with the major market segmentations? And this is from that same source Mario was talking about or earlier, that IBIS world. They have really, really good industry reports, especially for the wine industry. And I think it's really worth looking into deeper at those sources. And so this one specifically is looking at the major market segmentations. And so we can see a majority of that industry revenue does come from wholesales, but that next majority, or one of them, is that restaurants, hotels, and other food service providers, which I think is really important to look at. And so how are we getting our product to our consumer? And so one of the key takeaways that source was mentioning is the importance that competition is very heavy in this industry. And so you really need to be able to differentiate your bottle of wine, and really shifting to those consumer preferences. Because as we've seen, there's been, a major shift in the wine industry of what consumers want from their wine. And, there's been a shift away from alcohol consumption and that sort of stuff. So how can we, as wine producers, market off of that and really make our product valuable to the consumers who we're trying to sell to? Yeah. And so we look at these different value added strategies because, again, we use that example when you walk into that grocery store and look at the shelves. How do you know how do you make your product valuable to your customers? Because and so some of these benefits of using value-added strategies is they really create that competitive advantage. They make people reach for your bottle of wine. Stronger brand image, market expansion, so reaching different markets and different consumers. And then you can also have higher prices and profit margins. And so it really comes down to that idea of how do you compete against the other 300 plus vineyards in Virginia? And, all these other vineyards and wine producers across the country and the world. So we kind of have this general understanding that value-added strategies are good, especially in wine, but how do we know if they're right for your specific business? So how are we going to do that? We're going to use financial analysis tools like Mario had mentioned. And so the entire idea behind this is being able to make those data-driven decisions, because it can be really easy to, oh, this sounds like a great idea for my business, but how do you know if it's actually going to work? How do you prove? How do you use those numbers? And then also, how do you then go to, your credit loaners and all of these different peoples to prove that you have a valuable business idea? And so the two different financial analysis tools we're going to be looking at today is partial budgets. And so those evaluate the costs and benefits of a very specific change by analyzing the change in profits. So it's a very short-term decision-making model. It looks at a very specific change and the effects that it has on the business from that specific change. And then we're also going to be looking at a broader financial model, which it's a more long-term decision-making tool. It's dynamic and it tracks kind of the overall business over a set time to be able to predict that future performance. So we can go ahead and get started looking at those. And so we're going to be doing this through a case study example. And so for the case study, we're going to be looking at a very generic Virginia winery. And so again, this is just kind of made up numbers, but a lot of it is based off of the Go Virginia 2024 wine industry report, which again, I think that is another really useful report to look at. They have a lot of really good industry numbers, and a lot of what consumers are wanting is in that report. And so for our very generic Virginia winery, we're going to have 20 acres of wine, making 5,000 cases of wine per year. And we're just going to be assuming to starting out with their business model that they only produce and sell wine wholesale. They have no other ventures. So they don't have any sort of event space, wine tasting, tours. They're not going to festivals or anything like that. All they're doing is making 5,000 cases of wine and selling it off wholesale. So this business isn't using any value-added strategies. So there's a lot of different directions they can go. They can have different marketing and advertising techniques. They could, start going to festivals. They can start offering event spaces. They can do, lodging, Airbnb. There's lots of different ways that they can add value to their product. And so for this example specifically, we're going to be, yeah, you can go ahead and move on. So the change to this enterprise we're going to be making is we're going to start offering wine tastings and vineyard tours. And so that's the value added strategy we're choosing. And so we're going to be rerouting bottles from wholesale to direct to from wholesale to direct to consumers and tasting. So we're not increasing the production at all. And so the change we're going to be analyzing through the partial budget is just what's going to happen if this business starts to offer wine tasting and tours. And for this example, we're just going to assume that they already have some sort of infrastructure in place. For example, they have a horse barn that they can use the base of. So we're not assuming that they have to build a new building or anything like that. So let's start to look at some of these numbers. And so we're going to be building a partial budget. And so as the name kind of implies, we're looking at a part of an enterprise's budget. And so the first step of building a partial budget is, what is this financial decision that we're making? And so on the right here, you can see this is kind of an overall look at what a partial budget looks like. It's a very simple financial model, but it's a really useful tool that analyzes the financial impact of the change. And so we're only going to be looking at what changes in the finances from that change. So kind of a broad example, for example, if you're switching from a conventional fertilizer to an organic fertilizer, your input costs might raise. So you're going to have to, spend $500 more, but you're going to increase your crop revenue by 1,000. And so that change that's happening in your business is that $500 increase. And that's a very short example. But so let's kind of dive deeper into the specific sections of this partial budget. And so the first step is going to be to clearly identify and define the proposed change. And so because we're looking at a specific change, we want to be very specific with what that change is we're making and really clearly identify it. So for this example, for this generic Virginia winery, we're going to start offering wine tastings and vineyard tours as the change we're making. And you also want to be very clear from the start what sort of assumptions you're making. And so again, like I said, we're going to be assuming no additional infrastructure is needed. And then the units is what sort of time frame this is happening. Because partial budgets are short term, it's all gonna be 1 year or less. And so for this case, we're gonna be looking at what happens in 1 year. You could do weekly, monthly, but generally it's a partial budget is on a per year basis. And so to start off with, we have that good side. So those positive changes that happen from an enterprise change. And so that first section we have is added revenues. And so this is just basically money gained from the new business activity. So this is any new sources of revenue that comes from making that change. And so you can make these assumptions and make these predictions based off of any of your previous financial records you have and also market data. And so a lot of the information that we have for this example is just kind of general market data and general assumptions. And so again, all of this information is going to be posted after the presentation, so you can access all of these spreadsheets we used. And so you can play around with a partial budget on your own. And so any of these sections with the little red triangles next to it does have notes of where I got the numbers for this. But again, these are kind of general assumptions we're making just to kind of play around with the partial budget. And so for this example, our added revenues are wine tasting fees because we're now having wine tastings and charging that fee. That's an additional revenue that we didn't have before. Wine sales at tastings. So these are bottles of wines that would have been sold wholesale, but we are now selling direct to consumer. So before we started offering wine tastings, we didn't have that direct to consumer revenue stream, but now we do. And similarly, vineyard tours, we were not offering vineyard tours before, so this is now a new revenue stream, and food sales as well, because we weren't selling any food before. And so, on average, Virginia Vineyards saw an average of 9,600 tasting room guests. And because this is an up and coming business and just starting, we were assuming that they're going to see 4,800 guests per year. And then based off of the average tasting room fee in Virginia, we're going to be charging $20 per customer. And so similarly, we got some of these estimates. So wine sales from tasting, according to that IBIS world, 78% of vineyards, 78% of people who visited a wine tasting then purchased that bottle of wine. And so that's where we kind of got some of these other numbers from. And then we're assuming we're selling our bottle of wine for $25 per bottle, charging $20 per that vineyard tours and $15 on average for food sales. And so again, these are all on a per year basis. So that's how many customers we're expecting to see throughout the year, and then multiplying that by our dollar per unit to get and then adding all of those up to get our total added revenues. Now, what you might notice is that what's not included on this is any revenue from selling bottles wholesale, because that hasn't changed. In our enterprise, we were already selling wholesale bottles, and that hasn't changed with this new enterprise, so we're not adding it to our partial budget. And so this added revenues total is the total money gained from this new business activity. Now, the other good thing on the good side is reduced expenses. So this is just decreased costs from this new enterprise. So expenses that decrease or disappear because of the change. So these are any cost savings you're having because of the change to your business. And so this can be a lot of different examples. So like eliminating, no longer outsourcing services, lower transportation or marketing costs, improved efficiency, all of these different sort of things. And so for our example, because we were originally selling those bottles wholesale, and now we are selling them through our direct to consumer sales, we are no longer having those costs of distributing them wholesale. And so this 8,544 number comes from the number of wine bottles we are selling directly to the consumer, and then also the number of bottles that we are using for our tasting services. So these are the redirected bottles. And so we assumed $3.75 per bottle for transportation and distribution costs. And so those are separate from the cost of production. That's just the cost, for transporting the bottles, storing the bottles, anything associated with distributing wholesale. And so since we are no longer distributing those wholesale, this I want to switch slide mirror.
Hey, Michelle, you were breaking up a bit for me. I don't know if anybody else got that as well. Maybe it was just me?
Yeah, I'm getting that too.
Okay. It was just in that last part, Michelle.
Alrighty, well, I kind of summarize up what we got here, but so pretty much distribution costs, these are costs that you're no longer, because you're not selling these bottles wholesale, not having to transport them, you're selling them directly to your consumer. These are costs you're saving. So these are reduced expenses that you're having. And if we put this all together with the good side, I'm going to switch slides. So this is our total good side. So this is that positive effect part of the partial budget. And so we're going to add together those total added revenues and those total reduced expenses to get our total positive effects from the change to the business. And so for our example, if we were to start doing wine tastings, we were going to have a total positive effect of that 300,047,640. And so this is the total positive effect. And so this is what this change will earn the winery in addition to. And now also to note, some sections of the partial budget can be left blank if the proposed change does not affect that area. So for example, some changes you make to your business aren't going to have any reduced expenses, and that's okay to leave some sections blank. Yep. And then so with the good comes the bad. And so we're going to kind of do the same breakdown that we did for the good side, but for any of those negative effects that come from a change. And so that first one is those reduced revenues. And so these are any income loss because of a change to the business. This is money you would have earned before, but are no longer earning because of the change. And so these are any lost sales, any shifting production. If you offer like a 20% off discount, you're reducing those revenue. And so kind of similarly to the reduced expenses, we're now having reduced revenues. And so that is coming from those wholesale bottles. So that 8,544 number is that same number of bottles that would have been sold wholesale, but we are now selling direct to consumer through our wine tastings, and then also bottles purchased from the wine tastings. And so we have those units times our selling price of the bottle. So we are no longer earning that $25 per bottle from selling it wholesale to get that 200,013 total reduced revenues. So this is money we would have earned from selling wholesale but are no longer earning. And then the other kind of bad thing we have is added expenses. So these are any extra costs because of that change you're making. And so, for example, we're going to be looking at additional labor from offering wine tastings, wine used for the tastings, and then food costs. And so what's important to note here, the labor on here is labor just for wine tastings. Now, you probably would have already had labor expenses from producing your wine, growing your grapes, all of those different things, but those were costs and expenses you already had because you were already producing those 5,000 cases of wine. But so this labor is just labor from wine tastings and those vineyard tours. And then that wine used for tastings is the wine is those bottles you're offering for your consumers. And so for this example, we're assuming that you're using a full bottle of wine, per each wine tasting customer, which is a pretty high estimate. You're not going to use, when you come for a wine tasting, you're not drinking an entire bottle of wine, but it's important for these sorts of financial estimates. It's better to be on the more conservative side. Because if it's a lot better to, overestimate how much wine you're using, because then you can hopefully save some in the long run. And another important thing to point out for added expenses, for any long-term items, so for example, if we were to have to build a building and get a loan, or buy a large piece of equipment that costs a lot of money and is going to be used over multiple years, you want to put it on an annual costs, not the purchase price. So for example, if we were to buy a $200,000 building, this venture could be never be profitable if you just put that whole purchase price all on there all at once. And so we're going to use something called DITIS, which is depreciation, interest, taxes, insurance, and shelter, to put any of those long-term large expenses on a per year basis. Because remember, it's important to understand the units behind this partial budget. It's on a per year basis. Yes. And so again, making sure you're conservative with your estimates, and these are any additional costs from that change to your venture. And so we can put that all together on the total bad side. And so this is the total negative effect to the business from the change. So your added expenses plus reduced revenues. And so to kind of be able to use this partial budget as a decision-making tool, we compare the good and the bad side together. And so this is how we make the decision. And so you take your good side minus the bad side, and that gets your net change in profit. And now if that net change in profit is positive, then it's a profitable venture. And so that's assuming it should cash flow. But again, it's important to understand that this is just looking at this specific change. It doesn't tell you if this decision is the best change necessarily. Now, that's where it's useful to come in. You can make multiple partial budgets and compare them to understand different decisions that you can make. But again, what a partial budget tells you is if this possible decision will cash flow, will it be profitable? Now, on the other hand, if it's negative, then it's unprofitable. And so for this, our generic vineyard with these numbers that we used, as we can see, our net change in profit is negative. It's unprofitable, which means it costs more than it's worth. And the basic financial decision-making tool, what it all comes down to, if it costs more than it's worth, don't do it. And again, this is just one tool in the decision-making process. There's a lot of other factors that can be considered. And so we put this whole partial budget together. And again, this Excel sheet will be available for you to use. And you can play around with the different numbers and look at the different changes. But this is what it looks like all together. You can see your good side with the added revenues and reduced expenses, your bad side with those reduced revenues and your added expenses. And you subtract that total good from the total bad side to get your net change in profit. But the really cool thing about Excel is you can play around really easily with the numbers. So for this example, you can see that it's easy to adjust it because the different cells are linked. And again, I recommend that you kind of play around with it on your own time. But so for this example, we were originally charging that $20 per customer for those wine tastings. But when we bump it up to, because that was the average wine tasting fee in Virginia. But if we just bump it up to $30 per customer, then we become profitable. We make $7,760, which isn't a lot, but we can still see how you can play around with that. And so we could, using this Excel sheet, we could see the effects of if we had to, if we use less labor, instead of paying $22 an hour, maybe what if we only paid our labor $20 an hour? All of these different changes. And that's the really great thing about these financial decision-making tools, especially with Excel, is you can play around with these different numbers. So it all comes down to that idea of decision making and using these different tools to see if these business ventures will be profitable. And again, so partial budgets is just one tool in the decision making process. There's a lot of other factors that should be considered. Does this change your new enterprise support your brand's missions or values? Or an example that was used a lot in my classes, do you have access to the skills and staff to implement that change? You know, if you need 1,200 hours of labor, that's great. But if you can't, if you don't have the skilled labor in your area to be able to fill that position, then this isn't a great tool. Now, and another important thing to notice about the partial budget is it's just a short-term, very specific look at your business. But there's a bigger picture. Partial budgets only capture that one point in time, but businesses happen over time. This isn't just something that happens in a year. So we can use a profit and loss statement to be able to project income over time. And so a profit and loss is really useful because we're able to look at sustainable and long-term profitability. And this tool is really useful, you know, how we were talking about getting loans and grants and all of these different things, to be able to provide that more comprehensive picture of profitability for our business plans, for stakeholders and investors and all of those different things.
All right, and this is where I'll jump in about the profit and loss statement. But before we even do that, I want you to take a look at this picture, and I want you to imagine your vineyard 10 years out. What has changed? Are you still selling all your wine through wholesalers, through retail? Or maybe you have some guests staying over from Maryland overnight who are walking through the rows of vines, taking selfies, tasting your select offerings with some charcuterie. In other words, what does your long-term future look like? Okay, so these are some snapshots of some headlines and some information that I found online. And these reflect real stories from across the country regarding wine tourism and direct-to-consumer sales, meaning that value-added models are increasingly being adopted. So Airbnb even has a wine vineyard filter that's built into their app and online for their users. And if you look at that bottom right corner snapshot, that's from their website. It's directly from their website. So it shows that there is a demand from consumers for overnight stay experiences at vineyards. So what we're going to do today is explore how you might figure whether it's really worth it for your vineyard, and specifically if adding a lodging component like an Airbnb stay can help your bottom line. Okay, so why a profit and loss statement? So a profit and loss budget is kind of like a financial storyboard. You need to make your assumptions explicit and you see how everything ties together. That means your revenue, your costs, your investment, debt, taxes, cash flow. So for our multi-year projection today, we're going to be building a model together, and we're going to see if the potential of wine tourism as well as adding lodging like an Airbnb is worth it. So I just want to reiterate, this type of exercise is great for any multi-year projects that have many moving parts in which we want to see if value add is actually worth it. So before we dive into the numbers, it's just worth clarifying what exactly this is. So on the left, you have a full financial model like this 3-statement model. It has your income statement, your balance sheet, and your cash flow. So on the right-hand side is what we will be building today. And it's like a profit and loss statement or a simplified financial model with a lot of the components that are in the 3-statement model on the left. So it's going to focus on the vineyard enterprise itself over time with a lot of detail to estimate profitability, cash flow, your payback, etc. So the goal again is just to help you quickly decide if I add lodging in addition to these new wine tour services, tastings, and like food, how does it change my profit? And then later on, you can layer this into a full model if you're really planning to seek some value add into your business and you want to seek financing or capital. Okay, so these are some basic assumptions. We have our 20-acre farm, and we have 300 labor hours per acre. That amounts to 6,000 hours per year at $22 an hour that we're paying our laborers. And so we're still selling 5,000 cases a year at $25 a bottle, and $13.75 represents the $10 per bottle that it costs us to produce that bottle of wine, plus $3.75 per bottle in distribution and wholesale fees. So you're netting $11.25 a bottle. So you can already see here that your margin before overhead is pretty thin. So this income statement and cash flow represents a vineyard that only sells its wine through wholesalers. It's our base case with no value add. So I want you to look at this, and yeah, maybe the numbers look pretty good, but imagine a case where you have some outside shock happen, like maybe fuel prices have increased incredibly, and maybe you're getting pressed because now minimum wage has changed and has exponentially increased. Or maybe production of your wine, of the actual grapes, has gone down because there's this virulent pest or a drought that's really wreaked havoc on your crop. Well, that can really impact your profit. And the thing about value add initiatives is that it can provide a cushion to offset those negative events, in addition to substantially adding to your profits through multiple revenue streams. And that's what we're going to do today. So I want you to envision that our vineyard is ready to introduce a new value-added enterprise. We stick to Michelle's plan. So we have our new activities in the vineyard. You have your tours, your tastings, and the food. But now we also want to add an Airbnb lodge. So we want to bring in this multi-year project, and we plan on maybe 4 bedrooms and a prefab model. And in the same year that wine tours are happening, we've secured a bank loan of $145,500 at 8.5% interest. And we're just assuming we have no down payment. So we have a lot of increase of activity on the farm. The vineyard owner is taking a salary now of $60,000 a year because she's just managing more than just wholesale operations. It's tours, it's tastings, it's food, it's the new construction. So in 2026, we open our things up to Airbnb after construction, and people are booking. So over time, the lodging budgets helps bring more visitors, and it really raises our on-site revenue in the form of tastings, tours, and food. And in that first year, on-site revenue is growing modestly at 2%. And then for 2 years after that, we really have growth accelerating because that Airbnb reputation has kicked in and the word has spread. But in that final year, in 2029, growth has slowed to just 1% CAGR because now, as we can see, the market is saturated. Your neighbors, your neighboring vineyards have heard that you're doing Airbnbs and they've caught on and they want to make more money. And that's going to be kind of like the story of building our model today. So how would this look on our income statement? First, we want to look at how money comes in the form of revenue. So we have a couple categories listed here. We have on-site revenues, that's your tours, tastings, wine sales. Off-site revenue just represents business as is when we were selling straight to our wholesalers. Food sales, self-explanatory, and then lodging revenue, that's from our Airbnb. So the on-site revenue, that's a tourist tasting and food, that's modeled based off of visitor volumes and average spend per visitor. So by multiplying quantity of services and the associated prices and summing that up, you can arrive at the on-site revenue, and similarly, our food sales revenue. So we're assuming that compounded annual revenue growth and contraction of food sales is just moving in tandem with our revenue from the tours, tastings, and wine sales. So offsite revenues, that again is just our business as is. And it's continued and it's going to look identical to our no value add line. And lastly, our lodging revenue is just based off of occupancy rates, average nightly rates, the number of rooms, and our growth assumption. So you'll notice that revenue doesn't start until 2006 for our lodging right over here. That's because we're building construction and we got our loan in the year prior. So you'll see that in our base case to 2024, when we did not have any value add, we had $1.5 million in total net revenue. But across the board, across the years, you can see how that's really added up. However, as we all know, with new ventures come new costs. So how do we factor in the costs of all of these new ventures? We're going to be looking at COGS, and then we're looking at operating expenses or SG&A. All right. So We're going to decode all of this because it can get tricky deciding which items fall under COGS, which fall under selling general and administrative expenses, or SG&A. So let's just unpack all that together. Firstly, we want to just revisit what variable costs and fixed costs are. So as a rule of thumb, if cost moves directly with production volume or your guess numbers, think variable. If it's incurred regardless of how much you're making or producing, then it's fixed. And some costs can actually be semi-fixed. And it just means that those costs are usually constant until something happens in your business that has exceeded capacity. Like, for example, in the summer when the vineyard gets super busy and now you need to hire an extra hand to handle the rush, that's going to be a semi-fixed cost. So both COGS and SG&A can include a mix of variable, fixed, and semi-fixed expenses. But for our exercise today, we're just going to draw a really clear line. All expenses that are directly affected by producing wine is going to be COGS. And then everything else that's like related to running the business and all of our value add components like tastings and the Airbnb, that's going to fall under SG&A. So simply, if costs exist only because we're making the wine, like growing the grapes or bottling, that's COGS. But if that cost would still exist, even if production had just stopped completely, like admin, insurance, your, I don't know, software subscriptions, well, that's going to fall under SG&A. So just to clear all this up, I wanted to go through a quick number of quick examples together. So first example, would you classify the hourly tasting room server's wage under COGS or SG&A? So let's ask ourselves, is this person's wage tied directly to making the wine? Well, no, they're serving the wine and food for the tasting room. They're not directly involved in production. Even if we stopped wine production altogether, that server would still be working in the tasting room and serving guests. So that wage would actually fall under SG&A because it's part of our sales operation, not production. And what about our new farm manager? Well, our farm manager who's getting paid $60,000 a year manages the overall operations, right? That's coordinating staff, hiring, handling bookings, et cetera, And because this is focused on admin and management, not directly production, she's going to fall under SG&A. And what about someone like a farm crew member who's paid hourly to prune the vines, pick grapes, and maintain the vineyard? Well, in this case, their work directly affects our ability to produce wine. So if the vineyard stopped production, this cost would kind of disappear. So their wage clearly falls under COGS because it's a direct production cost that's tied to making the wine. And what about like repairs for your wine fermentation tank? This one is another clear COGS example. The fermentation tank is used exclusively for wine production. So its repair is necessary to make the wine. So that would fall under COGS. And for our last example, what about your credit card transaction fees on payment processing? Well, those fees occur when customers are buying, paying, tasting, booking a stay at the Airbnb. So that's going to be part of your SG&A. All right, so now that we've cleared that up, breaking down COGS, here, it kind of looks identical. It is identical, just for the sake of this exercise, to our no value added COGS. Because as we've already mentioned, our COGS are going to be tied to the production of wine. So everything else in our value add is going to fall under SG&A, which we'll look at later. So in our base vineyard, we have 5,000 cases of wine per year, producing 5,000 cases of wine per year with 12 bottles in each case. So it costs us $10 a bottle for things like raw materials and bottling and other production inputs. And on top of that, we pay our wholesaler distribution fee of $3.75 per bottle. And we also have the cost of labor directly tied to producing the wine. So that's going to be integrated in as well. And so again, just to refresh, these employees are working 6,000 hours per year in total, and they're getting paid $22 an hour. So when you tie all those things together, you can get your COGS. All right. Oop. There we go. And we can arrive at our gross profit once we've totaled all of our COGS, which is simply our total revenue minus total COGS. And that'll give us the first sense of profitability, but we definitely need to go on and calculate our SG&A to see what other things look like. So we go back to our income statement, operating expenses, SG&A, and it is all categorized. And we're going to look at that in more granular detail. So this is, again, the cost of running the business beyond just the wine production. And remember, all of our production-related expenses already fell under COGS. So this is the business operations side of things. The selling, the Airbnb, the admin costs, just to keep everything running day to day. And again, this is broken out by on-site, off-site, food costs, and lodging. And again, I know off-site kind of sounds unclear, so that's like your retail and all of your wine production. So with your on-site costs, that includes your expenses related to tours, tastings, and D2C sales. And I've also added website subscription fees because that's pretty realistic. It's and I looked at a couple different options online, saw $350 through Shopify. So that's an annual subscription fee that'll tie into our SG&A. And through our new on-site sales channel, we're now selling 2,400 bottles of wine directly to customers. Each of those bottles costs us $10, plus another 4,800 bottles sold through tastings. Again, $10 per bottle. And for credit card transaction fees, we're using Square's POS system. And for simplicity, I've just lumped all of those together for food and wine sales. So Square, I believe, charges 2.6% plus 15 cents per transaction. So all of that was built in. So in our first year, those transaction fees total to $10,176, and we've included that under on-site costs. So our hourly tasting room servers are paid $22 an hour, and they work 1,240 total hours per year. So we've also integrated our manager's salary of $60,000 that covers, she covers the operations, the hiring, maintenance, etc. And so for offsite costs, you're going to notice that we don't have any values here because that's already been captured in COGS. For food costs, that's just simply the cost of ingredients and food sold on site. So we're assuming $9 that it costs us in the first year and that we sold 2,400 units. And then lodging costs begin once our Airbnb becomes operational. So that's reflected starting in our third column when we're actually in service with Airbnb. And that includes cleaning and utilities, which was estimated at 3% of Airbnb revenue. Maintenance and repairs, that's 1% of revenue. And the Airbnb service fee, they charge 3% per booking revenue. So together, all of those things make up SG&A. And so now that we've calculated our COGS and operating expenses, we can move to our EBITDA, or earnings before interest, taxes, depreciation, and amortization. I can't really pronounce that last one. So EBITDA is simply calculated by subtracting our total operating expenses from our gross profits. So like in essence, we've subtracted total COGS and total operating expenses from our total revenue. And now we can move on to depreciation. But in order to do that, we are going to have to pull up our supporting schedule. So what is a supporting schedule? This is where some of our more complicated calculations are going to live. It's where we compute depreciation, interest, principal, loan balances year by year. And we need to figure out how the cost of our new Airbnb building breaks down over the years, and not because we're not expensing it all at once. So the building So if you look at the first two pieces at the top, you can see that we've calculated straight line depreciation, basically the same amount per year. And we've arrived at $4,850 for the life of the Airbnb that we're assuming is 30 years. So for annual depreciation, you subtract the salvage value from the cost of the building and divide that by the useful life of the building. And for this exercise, we're just assuming salvage value 0. So just simply divide this 145,500 by 30. And our income statement will reference that total depreciation by year right under EBITDA. So as a note, this number should ideally be positive because we'll be subtracting depreciation expense in the following EBIT line. So now that we've calculated EBIT, which is just subtracted from the depreciation from our EBITDA, we'll need to return to our supporting schedule to calculate our interest expense. And, okay, bear with me. Just to recap, in 2025, the vineyard got the loan and began construction, but that doesn't start we're not making any payments yet. So that principal repayment in the first year is 0, and interest simply accrues on the full balance. Then in 2026, when your Airbnb is operational and money starts to come in, that's when your loan payments start. So that's when we start separating each payment into interest and principal portions, and we're using Excel functions for that. So first we need to figure out how much we'll be paying the bank each month. And in order to do this, we need 3 things. That's the loan amount, the 8.5% annual interest rate, and the term loan, 30 years. So that's all up here. The monthly payment is calculated by multiplying the loan by the monthly interest rate. That's 8.5% divided by 12, and then dividing that by 1 minus the monthly rate raised to the negative power of the total number of payments. I know that was a lot, so boom, we have it right over there. And in Excel, there's a simple formula that you just plug in that handles all of this automatically. And Michelle, as she's mentioned, we're going to be sharing a QR code at the end of our presentation that links to all of this and a cheat sheet with all of these functions and built-in formulas. And so next, we're going to calculate our annual payments, which is simply the monthly payment multiplied by 12. Then we set our beginning balance for the year to the loan amount. Oops, sorry, didn't mean to do that just yet. And for 2025, we calculate our interest expense by multiplying the loan amount by 8.5%. And since no payments have been made yet, our principal is 0 and the balance remains the same. However, in 2026 and every year after that, we can use 2 Excel functions to split the annual payments into the total interest expense for the year, and that's what is going to the bank, and the total principal repaid, and that's the portion that's actually reducing the loan balance. So by subtracting the principal that we've repaid from the annual payment, you can always just check and verify that the interest expense is correct. So as the loan balance goes down by each year, so does your interest expense, which wraps up that loan component. And as you can see, those annual interest expenses link directly back to our income statement. Yay. Okay, so to get at your pre-tax income, which is the next line, you just simply subtract your interest expense for the year from your EBIT. And your income tax expense is calculated by multiplying the income tax rate, and we've assumed 25%, by the pre-tax income. And finally, you can get at the net income by subtracting the income tax expense from the pre-tax income. Yay. Okay. However, now that we've walked through the income statement and supporting schedules, we got to connect all of that together with the cash flow statement, which is super, super important. Our cash flow is the actual movement of cash in and out of the business. How much cash do we actually have to do things? So we start with the net income, which comes directly from the income statement, and from the income statement on the bottom. And since net income in our income statement includes non-cash expenses like depreciation, we gotta add that back. So, there we go. We add that back next to the cash flow statement beneath the net income. And in our case, depreciation begins in 2025, when construction starts and stays constant at $48.50 per year because we did straight line depreciation. And so next we look at capital expenditures, or PP&E. That's the cash the vineyard spent to build that Airbnb lodge. So you can see here that there's a negative $145,500 in 2025. In 2025 alone. So that represents the cost of constructing the building. And that is the only year that it's shown on the cash flow statement. So after adding back depreciation and subtracting that investment, we arrive at our free cash flow, the cash that we actually have available to possibly reinvest, repay debt, or take as owner distributions if we choose to do that. And this is where everything just ties together. The income statement shows our profitability, the loan schedule shows financing, and the cash flow tells us what the owner or you actually have on hand at the end of each year. So once we've created this P&L for a value-added enterprise, we can just compare our no value add against our value add. And because the type is so tiny, let's just zoom in a little bit. So as you can see, the value add model produces higher net income and more cash flow. That means our vineyard with the wine tours, with the Airbnb, now has more capacity to absorb some of those unforeseen risks that I had mentioned earlier, like a drought or spikes in production costs. And now we can reinvest that into our business. But just keep in mind that this also does mean that our enterprise will require more money or more capital. Things can get complex and it can potentially present some operational risks, which is why a multi-year P&L or enterprise plan, as well as a partial budget, can really help to see if value-added opportunities are worth it for your business. So you can see if a premium is justified for your vineyard. So Michelle and I have included some resources that you can take away with you. That first QR code is going to link directly to Virginia Extension's tools and other resources. And they have some really great tools like a financial calculator that I actually look to and I think is really useful. That second link links to a folder of our presentation, Michelle's partial budget, Excel, and my enterprise budget, and with all the assumptions in there and built-in functions. And there's also an additional cheat sheet for Excel, breaking down all the functions that you would be using in your financial model, which could be helpful. And additionally, we're going to be following up with you all with a feedback survey sent to your emails. So we would really appreciate any comments and any feedback that you have about the presentation as a whole. And please feel free to stay in touch with us and the Cole Center if you would like any help with your models or customizing something for your vineyard. So just want to say thank you so much for your time, and we hope that we were able to provide some insights and information for you all that will hopefully be helpful for you as you grow your business. Thank you.